Good morning, everyone. You are watching a live daily market outlook from Windsor Brokers for Wednesday, 30th of January 2013. The big day today, a lot of data, especially the US data, were long awaited by investors, are due to be released today. We have a list of ADP data, GDP for the fourth quarter, and then finally the Fed end of the two days meeting and the monetary policy and the rate decision. With the highlights starting from a single currency that at the beginning of the of the European session cracked psychological 135 barrier after being rather quiet during the Asian session, and following yesterday's rally that cleared and closed above previous highs at 34.77, with a few ticks above psychological 135 level seen so far, seeing a potential now for further extension higher as the positive sentiment established on some rather positive data from Eurozone and the other big, especially the Eurozone, and then from states, some positive data signaling that the worst of the crisis is behind us. Still, this is to be confirmed, but generally positive sentiment is seen among the investors as they keep pushing the single currency higher and higher and breaking some important levels. Now the 135 is a very important technical barrier. We're going to elaborate more of this in our technical part, but generally is the positive sentiment, as I said, and the risk appetite is back into play, and we might see higher levels of the single currency. Of course, after market digest tonight's Fed's data, we'll have a more clear picture, and we're going to take a look, of course, on the expectations for the FOMC's decisions today. Just to mention the other highlights of the major currencies and commodities, cable remains stable off its recent low when the 157 support has been briefly cracked, 156.73 low seen so far, and their support, the support was found at that level. Now in recovery path with approximately 157.78 zone seen so far. 158 is in near-term focus with the positive near-term technicals seeing potential for clearance. Of course, break above strong 158.25 barrier is required to confirm. Yellow metal remains stable and recovers of recent lows at 1650 zone with the nearly 1670 seen so far. 1668 is the highest seen overnight, while crude oil remains well supported and heads higher. 97.80s so far seen. We have Fibonacci expansion at 61.8% at 98.54 seen as the next upside target. From the data to be released today, US fourth quarter growth is seen at 1.1%, showing the slowest pace in the nearly 2 years, while the Fed is expected to keep bond buying at $85 billion a month, and the rates expected to stay unchanged at zero. As we said, the Federal Reserve is ending its 2 days meeting today, and they expected to keep the monetary policy on a steady path where it concludes when it concludes the 2 days meeting today. Though behind the scenes intensive debate continues over when the controversial bond buying program should be ended. The policy statement issued by US Central Bank at the end of the meeting will likely be, according to the expectations, one slightly rephrased from its meeting in December, and would reflect minor changes in the economic outlook, notably reduced risk from the financial turmoil in Europe. Otherwise, economists expect that policy meeting of FOMC will maintain asset buying, as we said, at $85 billion a month, and retain the commitment to hold the interest rates near 0% until the unemployment rate falls to minimum 6.5%, provided inflation does not threaten to break 2.5%. This is what we spoke in one of the previous sessions also about the unemployment that is still disappointing point in the U.S. economy. The Fed has taken unprecedented steps to try to spark a stronger economic recovery and drive down unemployment, kept the overnight interest rates near zero since late 2008, and has launched 3 rounds of bond purchases known as quantitative easing to drive other borrowing costs down. The recent data has been consistent with the gradual improvement in the economy, although the government's monthly labor market report to be released on Friday is expected to show the jobless rate to stay stuck at 7.8% in January. That is will be another quite disappointing thing. As we said, the unemployment is another one of the weakest points. As shown, ADP non-farm payroll, non-farm employment from United States is due at 13.15 today, and this is the one of the indicators for the Friday's non-farm payrolls data. 164,000 is seen forecasted versus the previous month 215,000, and any figure below this, the previous one in December, could be again another disappointing signal of the still weak U.S. economy and showing no improvement, at least regarding the labor market. As we said, GDP for fourth quarter expected at 1.1, quite disappointing. This is the slowest, as we said, since 2011, I think, or we said, or 2013, 2012. The slowest pace, and any figures around the forecasted levels or below would be another quite disappointing signal. Just to go back from the already released economic indicators, GDP for the third quarter from Spain came at lower than expected and lower than the previous third quarter. At -0.7 was the release for today versus -0.6% forecast and -0.3% second quarter release, while also the COF economic barometer from Switzerland for January again came significantly lower from the previous month. That was 1.28, and the 121 forecasted. Quite disappointing data so far released for today. The data that are due soon, 9:30 GMT, are more from the United Kingdom. Mortgage approvals for December, a slight improvement seen at 55,000 compared to 54 in the month of November. Net lending to individuals is expected to increase 2.9 billion sterling in December compared to a draw of 100 million sterling in month of November. And then we have ADP non-farm employment change that is due at 13.15, and then US GDP data at 13.30. Crude oil inventories are, I think we have the wrong time here, should be at 15:30 if I'm not mistaken. Today is Wednesday, so this is going to be corrected. Build of 2.9 million barrels is seen in the past week compared to the previous week's release at build of 2.8 million. And of course the data from United States Fed's decision due at 19:15 GMT. As said, the rate close to zero is expected to stay intact, and the statement will follow the rate decision. Another central bank decision is seen later in the evening at 20 GMT from New Zealand. Central Bank of New Zealand is expected to keep the rates unchanged at 2.5%, and these are the most significant releases seen on today, on Wednesday, 30th of January. I mean, the main focus, of course, is on the U.S. data that commenced at 13:15 with the ADP data, and then GDP data, and of course the FOMC's decision. And technicals now come in focus. We're going to see what has happened so far in the past 24 hours and what we can expect in the coming hours in the markets regarding the major currencies and commodities, with the euro now breaking posting fresh high at 135.14. This was followed by yesterday's rally. With the boost was seen from the European and Far East European buyers that pushed central big names, I would say buyers that pushed the single currency higher through previous 134.77 peak, staying steady just under 135 during the Asian session, and this morning's fresh action is now seeing a brief break above 135.00. Positive sentiment and a strong bullish momentum still exists and sees potential for further extension higher as the pair remains well supported for now. And basically we have seen already the scenario at 133 and then 134. Now we are at 135 after a brief consolidation here. Possibility of further extension and following this pattern is seen quite likely. Fibonacci expansion of 76.4 seen so far at 135.07. This is the expansion of the larger picture upleg from the third wave from 126.60. Now we are facing the weekly 200 days moving average that is currently at 135.25. These are the barriers, immediate barriers on the upside. As Fibonacci barrier has been cleared, now 135.25 is the next one, and then we might be looking for December 2011 and November 2011 highs 135.47 and 135.67. Following, it's still not confirmed, fully confirmed, but it seems that we have the break above the neckline of the weekly head and shoulders pattern that comes around the 135.490, 135.00. Break, clear break and close above 135 is basically now required to confirm the breakout, and the open way for more significant gains 135.47, 67, 136 seen so far, ahead of another significant Fibonacci barrier expansion of 100% at 137.68 seen in the near term. As said, positive structure that dominates, although the daily indicators are quite extended, yet we don't have any firm signal of reversal that leaves some room for a further extension higher. Of course, the release of US data today will again give us either confirmation for the current strength, or it will show that any decision has already been priced in, and we might see some corrective action, profit taking in case of further surge higher, with immediate support at 134.77 previous highs, and the 134 zone expected to contain any stronger dips if we consider it as like current top at 135.14. Then it comes around 38.2% retracement, and this is also yesterday and day before the consolidation range floor, and also the previous highs at 134.00 seen is the near-term break point in case of break below 134. So far, this level is expected to contain in order to keep immediate bullish structure in play for possible further extension higher, as we are now attempting through 135 stronger resistance, and the break higher would be a good signal for some stronger recovery, as shown on the, I think we have it better here on the weekly chart. This is 50% of the larger 149.38 to 120.42, seen as a trigger for some stronger rally, and the levels as mentioned on the upside on the downside. British pound, positive sentiment of recent low at 156.73 posted 2 days ago still persists, though the price action got congested under 158, 157.72 seen so far, and we've been congested here from yesterday afternoon, unable to break higher. The sentiment is still positive, and the near-term price action is supported by bullish crossover of 20 over 55 exponential moving averages on the hourly chart, with the bulls on the hourly still out of play, but still existing in the 4-hour chart according to the ADX studies, though the pair is now struggling at 20 days. Exponential moving average currently at 157.50 on the 4-hour chart. We need to see the break above 158, 158.25 in order to confirm the recovery, to confirm the near-term base at 156.73. That's the lowest so far, and open way for some stronger recovery. Basically at around 158 we have 61.8% retracement of the down leg from 158.91 down to 156.73, and the previous high of last Friday at 158.25. Break above these levels is seen as a trigger. Hourly structure remains so far positive, though losing momentum, while the negative tone dominating on the 4-hour chart. Studies sees the increased risk, downside risk, in case of failure to regain 158 to 158.20, with the lower top and the fresh slide lower as a part of the larger downtrend. The latest down leg is from 161.77. Extension of the larger downtrend seen quite likely at risk in case of a failure to extend the near-term recovery through 158, 158.25, with the alternative scenario seeing a fresh slide down through 157 as a previous support, now again acting as support, and the 156.73 that may open way for a further weakness as a part of the larger downtrend from 163.80 down towards 156.34 and the 156.00. Basically, since we lost briefly broke below 157.00, the downside remains vulnerable, with the strong bearish momentum seen on the daily chart, still keeping the downside firmly in focus. As long as we are below 158, 158.25, this also marks the previous range floor and is seen as a break point. Holding below these levels keeps the risk at the downside. Dollar yen has regained some ground and basically retesting currently the previous high after brief corrective action from 91.24, previous high of 28th of January 2012 was contained by ascending 20 days exponential moving average of 4-hour chart at 90.31 and keeping the more significant supports at 90.23 previous high and 90.00 psychological and 38.2% Fibonacci retracement of the latest up leg from 88.05 to 91.24 intact. This support was also underpinned by 55 days exponential moving average. As this stays intact, the fresh strength and positive momentum, positive sentiment drove the price again higher. We broke briefly above 91.24. That signals extension of the larger uptrend that commenced in September 2012 from levels approximately 79 and sees potential for further extension higher as the pair retraced over 76.4% of the down leg from 2010 high at 94.97 down to 2011 low at 75.55. Seeing more potential towards the upside. On a weekly, the MACD is now just breaking above the midline, whilst all the other indicators are pointing strongly higher, and most likely the immediate support, immediate resistance, pardon, then lies at 92.00. This is our next upside target, with a likely scenario seen in the near term extension towards 95 zone. This is the previous high of 2010, posted in May 2010. Near term supports 90.31 is the first significant and should contain any pardon, any reversal in order 90.31, 90.23 and then 90.00 contain any dips in order to keep immediate bulls intact for a fresh extension higher. It seems that current corrective action is over for now, and we are looking for the further extension higher. And finally, dollar Swiss remains under pressure. Bears are now in play on the 4-hour chart after a brief break below 92.00 yesterday to 91.91, and the quick recovery sees the price now congested within the narrow range of 92.06 and 92.25, approximately 20 pips, still unable to clear the initial 10-20 days moving averages. More negative tone, I would say, is still seen at this point, as both lower time frames chart studies 1 and 4 hour are in the negative territory, and of course seeing more focus towards the downside. 4-hour stochastic is reversing higher. I think this is already seen on the current bounce higher, and unless we regain levels at 92.40, 92.50, I would say at this point, it's a 50% retracement of the downmove from 92.91 to 91.91, reinforced by descending hourly 55 days exponential moving average, and the 92.50 zone, which is the previous low of 28th of January, as well as 61.8% retracement. Not much to be expected on the upside of recovery. Otherwise, break above 92.50 as a minimum requirement would see some stronger recovery action, but still holding below 93.00. Everything will be seen as could be described as the corrective action. Conversely, negative tone that still dominates sees the current bounce just as a brief correction before the fresh slide lower. That will be confirmed on the lower top under the previously mentioned levels, and attack of renewed attack at 92.0091 is to trigger fresh extension lower. We have immediate support at 91.75, 76.4% Fibonacci retracement of the uplift from 91.09 to 93.87, and basically break here is to focus a strong support zone at 91.00, 90.80, where we have the previous low of 11th of January 2012, and then the base of end of December at 90.80 zone. That may come in focus in the near term in case of further extension lower. Significant is also a brief break below the broken bear trend line of 99.70 high. That could be another negative signal for the pair. And finally, the commodities. Crude oil remains in the strong path as fresh extension higher. Yesterday's strong rally peaked at 97.80 so far after breaking above the congestion under 96.90. Clearance of 97, what we mentioned in yesterday's reports, is has been required for extension of the larger uptrend. As reminder, just to see the daily chart, shows the strong rally from 85.20 higher low of 11th of December 2012, with clearance of 96.80, 76.4%, and the previous high at 96.90. Now opening way towards resistances at 98, 98.27. This is the high of 23rd of August 2012, and then as expected, the $100 per barrel psychological barrier is already in the near-term focus, and it seems that the oil price is rallying towards that target. Just a brief look at the technicals. Quite extended conditions seen on the hourly chart, and the brief loss of momentum might trigger some corrective action, while the 4-hour indicators are still very positive, and see no signals of any reversal for now. That leaves room for further extension higher. However, any reversals should face the initial support at 96.90. This is the previous high, and more significant is 94, apparent 95.50, 95.00. Any dips should be contained at or above these levels in order to maintain immediate bullish structure in play and keep focus at the upside. Otherwise, bulls might be delayed for some stronger corrective action down towards 94.80 and 94.00. So far, good supports at 95.00 are seen guarding any further extension lower. And finally, the yellow metal. Corrective action of 16.51. This is the strong support, I think, better seen on the 4-hour chart. 61.8% Fibonacci retracement of 16.25, 16.97. Rally so far contained the dips, and we are in the recovery mode of there with the 16.68 seen so far. I think these are the also Fibonacci levels, if I remember well. 38.2% retracement of 1695 to 1651 descent. The first requirement, I think in yesterday's written analysis comments, I mentioned this area as a strong resistance and did not expect a breach here as the yellow metal remains in the strong downtrend. 1668 and 1672, which is the previous high of 25th of January, should contain, along with 50% retracement, should contain the current corrective action, while break higher would be quite supportive element at this point that will allow for some stronger recovery and basically prevent a scenario of further sliding down towards 1642 and 1635, and of course the low at 1625. Hourly structure remains supportive for now, as indicators are well above their midlines, pointing and the price above all moving averages, while 4-hour indicators situation on 4-hour chart is still shows the downside vulnerable, as indicators are all below their midlines. 14 days momentum is above the midline, above its 7 days moving average, while 22 days momentum is still below the midline. MACD is still below the midline. RSI is in the positive territory. Minimum requirement, as we said, break above 1668 to 1672. That marks also this 55% exponential moving average, previous high, and the 61.8%, pardon, 50% retracement seen as a trigger for some stronger recovery. Otherwise, we might see the further easing and the test of initial 1660 and then 1650 level. So far, recovery holds the positive momentum, but as said, if we don't see the break above 1672 on the upper side, then immediate risk will be still seen of lower top and fresh extension lower, as the yellow metal is in the near-term downtrend from 1695 peak of 22nd of January 2012. And that's all from my side. Please, questions, suggestions, comments, you can send them right now. Perhaps I spoke a bit fast today, and it seems for the same period of time I said much more information than usually. Since no one is raising any question, I will just take an opportunity to tell you that you should keep an eye on today's releases. They are very important, and see the market action and the reaction of on the current the question, how the big traders funds make money if the market euro-US dollar keeps going up and the market doesn't go down. Simply they follow the trend and they create the trend. So when the big guys get in the market, the trend is already established. Whoever from the small ones manages to jump in, it's very good. If you jump in the middle of the move, then you greatly reduce your opportunity to make money, because once they are in, once the orders are placed, the market is already pushed, and of course when the huge amounts are bought or sold, then market gets shot. Yes, that's yesterday's reaction. I said the big names were buying a euro from approximately 134.50, and they came out within 50 pips range, or some rumors were saying that a big Asian central bank was capping at 135. So basically they were balancing each other. But of course, when the big guys get in, market is already moving. So if you are lucky to catch the move at the right time, then you can make good profits. Just a reminder that big guys are driving markets and not the small ones. And of course, the golden rule, stay with the trend. So if you see it moving up, you buy. If you see it going down, you sell. Otherwise, you are quite in danger. And of course, when there is a clear trend, that's the best opportunity to make money. Any range trading has a great opportunity to make, but a great risk of losing money. And most of traders are out of the game during the range trading, waiting for opportunity for a trend to be established. As we can see on euro, there is a clear trend up, and if you just follow the patterns how it goes, then you will see that certain points are seen. This is what I'm mentioning also. Moving averages, retracements, you can always see that one of the these indicators caps or supports the market. So if you follow this pattern, then it's a great opportunity to come out with the good profits. Of course, trading according to all rules and the strong discipline in the trading, I don't want to elaborate about this too much now, is one of the golden rules, along with the one trend is your friend, and then you have great opportunity to profit in your trading. If there is no other questions, I would like to thank you all for being with us. Keep an eye on today's releases, and as they are very important, although most of the activities I think have already been priced in, but just keep an eye. Don't stay in the market without watching when the data will be released. Today there are a number of data from United States, and I expect to see you tomorrow morning again at 8 o'clock GMT, our regular time for the live session, where we will talk more about impact of the today's US data release. I wish you a nice day, and of course very good and happy and profitable trading. Good luck.